Welcome back. For those of us that are married, we spend the majority of our time building our retirement puzzle together with our spouse. We carefully fit the pieces of our combined income, investments, and Social Security to create a complete financial picture for our future. But what happens to the puzzle when one person is suddenly gone? It's a scenario no one wants to think about, but failing to plan for it can lead to a devastating financial shock. Today we need to talk about one of the most misunderstood and painful parts of the taxes puzzle piece: a sudden and dramatic tax increase, often called the widow's tax. The first thing to understand is that the widow's tax isn't an actual tax. It's a situation. When you're married, you get favorable tax treatment. Your standard deduction is large and your tax brackets are wide. But in the year after your spouse passes away, your filing status changes to single. Your standard deduction is cut roughly in half, and your tax brackets become much tighter. Here's the problem. While your tax brackets shrink, your income often doesn't shrink by the same amount. You might still have pensions, investment income, and RMDs from your late spouse's IRA. You end up with nearly the same income, but it's now being squeezed into a much smaller tax structure, forcing you into a higher tax bracket. This creates a painful domino effect. As a couple, you receive 2 Social Security checks. As a widower or widow, you only get to keep one of those, the larger of the 2. So your Social Security income is cut, but your overall household income from other sources may not go down. This often pushes your provisional income higher relative to the single filer thresholds, meaning a larger portion of your remaining Social Security benefits becomes taxable. On top of that, you may inherit your spouse's traditional IRA, which comes with its own required minimum distribution, further adding to the taxable income. It's a perfect storm for a sudden massive tax hike during an already difficult time. A common misconception is that this only happens to the very wealthy. That is just not true. This impacts middle-class families with well-funded 401ks and IRAs the most. The second misconception is that it's unavoidable. It's not, but it's best to plan for it while both spouses are alive. The key is to look at your puzzle from a long-term perspective. The must-do is to strategically reduce the amount of money held in tax-deferred accounts like traditional IRAs. Strategies like Roth conversions done over many years can move money from the taxable bucket to the tax-free bucket. This reduces future RMDs and creates a source of tax-free income that the surviving spouse can rely on without triggering a tax avalanche. Planning for the loss of a spouse is one of the most important acts of financial care you can provide for your family. It ensures your puzzle remains strong and secure no matter what happens. You're not just planning for your retirement, you're planning for their retirement too. It's about smart and compassionate planning that protects the person you love from financial hardship. If you'd like to learn more about retirement and tax planning, please explore the videos in our online resource center. Or if you'd rather have a private conversation about protecting your family, schedule a free 15-minute call today. Thank you for your time and have a great day.